Rarely do I find companies in such a good position. The last one, I believe, was probably the Daily Journal a couple months ago. Today, we're looking at another phenomenal company, a rather condescended computer chip maker in the competitive realm of computers and technology, and explore why I think it's shaping up to be one of the best companies to own in the next decade. It's one I'm sure you've all heard before, Intel. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. In 1968, Robert Noyce and Gordon Moore founded Intel against the landscape of a tiny little city in California, without the fabled garage of so many Silicon Valley tech giants. Both men had been employed by another prominent semiconductor company, Fairchild Semiconductor, before they created Intel. They garnered investors and the leadership prowess of Arthur Grove in 1971. Soon, Intel quickly made a name for itself with its ability to make semiconductors and logic boards. However, the company wouldn't really rise to prominence until the widespread adoption of the personal computer. It's been a long time since 1968 though, and Intel has moved far beyond its beginnings as a semiconductor maker. Don't worry, that's still a large part of its business. Nowadays, Intel has a hand in just about every industry involving electronics. We're talking everything from cloud computing, AI, and analytics, to owning companies developing technology for self-driving vehicles and machines. With this kind of involvement, I think Intel has a very interesting future still ahead of it. Despite recent reports that Intel is dying or will be outmoded by companies like AMD and Nvidia, there's no denying that Intel still has an absolutely titanic hold on the market and is continuing to grow tremendously. Now let's talk financials, Intel's financials, and see if we can find some of that potential for tremendous growth. As I'm sure we all know now, if a company doesn't have a solid financial footing, it could be left vulnerable in a crisis, and that's not good for any investor. As always, let's begin with revenue growth. If the report's claiming that Intel is on its deathbed, then we can expect to see revenue decreasing every year. However, Intel is actually growing rapidly. In 2015, Intel's revenue stood at just $55.36 billion. Now, in 2020, the number has jumped to $77.87 billion. You need to note that Intel is a massive company. This kind of growth is incredibly massive too. That's almost 50% revenue growth in just 5 years. Next, of course, is shares outstanding, which is a representation of a company returning capital to shareholders. This is my favorite way that a company can use its free cash flow. In 2015, Intel had 4.74 billion shares outstanding. Now, in 2020, the company has just 4.2 billion shares outstanding. Basically, Intel is buying back shares and increasing your ownership stake in the business and causing an increase in the per share price of its stock. Next is free cash flow growth. Much like revenue growth is very strong for Intel, going from 11.69 billion in 2015 to 20.93 billion in 2020. This is somewhat expected with such strong revenue growth, although I think it is important to note that Intel was able to increase their free cash flow by almost 100%, doubling the number, with their revenue only going up about 50%. Now we're going to take a look at current assets versus current liabilities. Current assets total $47.25 billion, with current liabilities around $24.75 billion. Naturally, Intel checks this box off, but one thing I didn't expect was the amount of cash Intel has on hand. The amount of cash on hand for Intel is $23.9 billion. This means that if they wanted to, Intel could totally pay off all short-term debts with the cash on the books right now. Again, for a company so massive, this is impressive. Having a lot of cash on hand is actually, in my opinion, underrated. All that cash on hand essentially is security for the company. To slightly change the words of the immortal Peter Lynch, it's very hard for a company to go bankrupt if they have enough cash on hand to pay off all their debts. Our last main metric is the average free cash flow over these last 5 years, and it comes out to $14.93 billion. If we multiply this number by 20, we get an expected market cap of $298.6 billion. Intel's actual market cap right now is roughly $232 billion. According to our free cash flow model, Intel is fairly undervalued. The following two parts of our financial analysis are return on invested capital and Intel's dividend. The first is return on invested capital, or ROIC. Intel's ROIC is 16.37%. Another huge reason why I love this company. 16.37% is well above our goal of 10%. Basically, this just means that Intel is very good at investing its capital back into its business. ROIC is a very important metric because it paints a picture of how the company is using its capital for you, the investor. After ROIC, we we want to look at Intel's dividends. To start, Intel's dividend is a solid 2.43%. This is easily covered by their free cash flow as the payout ratio is only 30.02%. Intel's dividend translates to, currently, $1.39 annually or 35 cents per share per quarter. Another metric just as important is total shareholder yield. Total shareholder yield is the total of dividends plus stock buybacks. This metric measures the total and tells us a more accurate story than just the dividend yield by itself. Last year, most likely bolstered by the events of 2020, Intel posted an incredibly impressive 11.40% shareholder yield. On the flip side, Intel's average over the last 5 years is actually 6.36%. While dividends are probably the most talked about metric and are the easiest tangible returns you can see, share buybacks are a more behind the scenes deal. However, in my opinion, share buybacks are a better option for companies to return capital to shareholders. Basically, you receive a 2.43% dividend, but the share price increases by 8.93% because of Intel's share buybacks. This gives investors a total return of 11.40% last year outside of other stock price movements. Now that we know how strong Intel is financially, it's time to move on to the meat of this video, why I think Intel still has tremendous room to grow. To do that, we'll start with the part that Intel is most known for, CPUs. In terms of CPU market share, Intel has a commanding lead, taking almost 79% of the total PC CPU marketplace. I really don't see this changing anytime soon. You can make the argument that in recent years AMD, Intel's closest rival, has been closing the gap. However, Intel still has the bigger, solid foothold in the market. It has deals with some of the biggest names in PC manufacturing, like Lenovo, HP, and Dell. Even the US military has contracts with Intel, and the US government, for the most part, only has contracts with Intel. The fact is that Intel is only one of 3 companies in the world, in the world, that makes such advanced CPUs. Taiwan Semiconductor and Samsung Electronics, 2 non-American companies, make up the other 2. Another strong point is that Intel has brand recognition. It's a household name. This is something that I've frequently touted in previous videos, such as my video on Apple. Brand recognition and preference is a very hard thing to break. Why is that? It's possible that most people still believe that Intel is the superior product. After all, Intel has proven itself to be the product for many, many years in terms of PC processors. Of course, there are people converting to AMD for its slightly better computing power and chip making, as demonstrated by Linus Tech Tip, video in the description below. Even so, Intel's superior products will be hard to match, let alone beat for any competitor, including AMD. On top of that, with Intel's stronghold as a widely recognized brand, AMD will see a long time pass before the public changes its perception about the company. Even if Intel is slowly losing the power battle for computer chips, there's an overall trend that we need to talk about: the slow decline of PC purchases over the last couple of years. In the first quarter of 2015, global PC shipments, not just for Intel, sat around 71.7 million. Then, by the first quarter of 2020, those numbers had plummeted to 51.6 million. Yet, interestingly, those numbers reversed by the first quarter of 2021, possibly in response to the fun events of 2020. That fall in numbers between 2015 and 2020 could also be somewhat attributed to the chip shortages during the time, but no one can say for sure. But I still think it's an interesting phenomenon to note either way. Here's something else you might want to consider. While AMD is running as fast as it can to the chip making and CPU industry, Intel is moving away from it. In recent years, Intel has announced that it's pivoting into the cloud computing space. Just last year, the company doubled down on this by unveiling new lines of processors like Intel Xeon. Along with this, Intel has started making a more concentrated push into storage with Intel Optane. Despite the divestiture of the main part of Intel's SSD business, I believe this will allow Intel to focus on this new storage form. Of course, it'll be a while before Intel can reap the rewards of such heavy investing into the cloud computing space, but I still believe that this is where Intel's future lies. As the company grows, it's going to need to continue to find new avenues like cloud computing to continue the growth every year, and Intel's possibly found that new avenue. With its ability to morph and adapt, Intel's huge bet on cloud services also appears to be working too. It's true that Intel has suffered from leadership problems in the past. That's probably where the bad reputation, despite its brand recognition, comes from. CEO Brian Krzanich pushed Intel's focus and money into mobile chips, and it really didn't work. He also left the company in a rather scandalous way, leaving his role to be filled by a less than fit for the job candidate. We will not name this candidate turned CEO because the position is now filled by Patrick Gelsinger, who started with the company 30 30 years ago. It's safe to say that he knows the business and the company pretty well, something I like to see when a company gains a new CEO. One of the things that Gelsinger did as CEO was reaffirm Intel's investments in the cloud computing space. With the great promise, though, comes substantive risk. One risk that Intel faces is a consolidation of the cloud computing space. There are 7 major data providers in the cloud space, and Intel sells to a lot of the smaller data centers, giving it stronger pricing power. If these smaller data companies start consolidating, then Intel starts to lose that pricing power, and that's a pretty big deal. The Big 7 could easily drop Intel and just go with Taiwan Semiconductors or Samsung Electronics. Intel already has limited leverage with these large cloud providers because it's relatively new to the playing field. Even if this is a major concern, I doubt the consolidation of these smaller centers will happen quickly, but it's still a possibility. Plus, with certain bills like the anti-monopoly bill forming and making its way to the desk of government legislators, the already fragmented cloud space could become even more fragmented, which affects the whole of it, thus affecting Intel. It's also claimed by many that Intel is dying because Apple pulled its contracts from Intel, and that doomed Intel. That's laughable really because Intel's contracts only accounted for 1 or 2% of Intel's total revenue. Apple's going in the opposite direction that Intel is, and its products will still have Intel products in them for 2 or more years before they're transitioned out fully. 2% loss over 2 years really doesn't seem to spell Intel's demise to me. As long as Intel can maintain contracts with many of the major PC makers like Lenovo and Dell, I think the public PC chip side of the business will be just fine. Really, this is where my whole Intel investing thesis comes from. I believe that the investments that Intel is making in cloud infrastructure will pay off way more than people are expecting. Even if these investments don't pan out the way I may anticipate, it still has brand recognition and a solid foothold in the CPU and chip space. Intel is still an incredibly strong company financially. It will continue to reward shareholders with a solid dividend and tons of share buybacks. You get all this while you wait for the cloud side of the business to really ramp up. Win-win all around in my book. That's why Intel will continue to be one of the largest positions of my portfolio over the next few years. Like always, I want to get Intel at a cheaper price. Regardless of that though, I believe Intel is still incredibly worth investing so long as you share a similar vision of its future, and that future being the complete domination of the cloud infrastructure business, or at least a solid ground in it. If you enjoyed this video, leave a like and subscribe to my channel. Until then, I hope to see all of you in the next episode of Dollars and Cents.